So let me move gears to another really cheery topic, returns. So this was from The Economist magazine maybe 5 or 6 months ago. They were trying to figure out how could we predict how returns might look over the next 10 years. And they took a look at price-earnings ratios and current bond yields and all of these other factors. And based on traditional portfolios, roughly 60% stocks, 40% bonds, they came up with this chart from 1900. So each point on that chart reflects what they think the returns will be in the next. So right here in 1985, the predicted return on assets for the next 10 years in real terms after inflation would have been 10% a year. And in actual fact, this is very accurate. That's exactly what happened. So why this is important is if we look at today, the expected return for the next 10 years on a traditional balanced portfolio is in fact 2% a year for the next decade. They're not the only ones who think that. So there's a very, very good investment manager in the US named Jeremy Grantham who runs a company called GMO, and GMO is managing about $140 billion. He's been running it for about 40 years, and they have a very good track record as well. They do an analysis every year about all different asset classes to see how they are likely to perform. He says there's no asset class, no individual asset class, so that's stocks, bonds, real estate, timber, that in his opinion is going to generate more than a 5% return. And if you took them all together and created a nice balanced portfolio, he comes to the same conclusion as The Economist, 2% a year after inflation, which is a lot less than most people are shooting for. And finally, this is in Canada. This is a report from McKinsey on exactly the same topic. One of the top Canadian investment managers, Kim Shannon, and Michael Sabia, who runs the Caisse de Depot in Quebec, are all basically saying exactly that same story. And what do they think the drivers are? Like, why should the next 10 years be so dismal in terms of returns? Well, the drivers are this. We have aging populations, reduced productivity growth, partially because of the aging populations, rising interest rates, which will affect bond returns. In other words, you'll earn more interest, but it will affect the price of the actual underlying bonds. Lower profit margins for companies, and higher taxes. And some of that you've already seen. The taxes, in fact, have gone up. So it raises an interesting question, which we wanted to look at, because this is kind of, depressing in actual fact, to look at this. So I went back to 2000. I thought, okay, well, let's first see if the problem isn't that the model that they're using is flawed in the first place, because our belief is it is flawed. This is, you're looking behind me here on the screen is a balanced portfolio. Typically, conservative investors at 50-50 stocks and bonds, 60-40 stocks if it's a moderate risk, and 75% stocks if it's aggressive. This is very traditional. You see this kind of portfolio allocation all the time, all over the place. So the question is it the right model? Was it the right model? And let's take a look at what the annual returns were. So I'm now going to give you the inflation-adjusted returns for the last 16 years, not the next 10, the last 16 since 2000. So the balanced conservative investor earned 2.3, the moderate 2.1, and the aggressive 1.8. This is all using stock market indices like the S&P 500, the TSX, and the bond indexes that are available. So the bottom line is that the problem of a 2% return is not new. It's been there for the last 16 years because it's not the return issues that are cropping up that are problematic. It's the portfolio design that's a problem. So you're looking here at a number of major institutions in Canada, and this is what's in their balanced portfolios or their balanced pools as of a few days ago. And in all cases, it fits one of these three models. It either is a stock or it's a bond. So let's take a look here at some alternatives. I don't know if any of you are familiar with the group Tiger 21. Tiger 21 is made up of typically retired business owners and wealthy individuals. They belong to kind of a peer group. They sit down, they work out how their portfolios are invested, and they meet typically about 7 or 8 times a year. You need to have $10 million minimum investable assets to be a member. And typically, and on average, the average member's got about $70 or $80 million of investable assets. So let's say these are pretty wealthy people. And they give a portfolio design. So they go through this and publish this on the web each quarter. This is the latest one that says, for example, unlike the 60% public stocks, they have 48% of their money tied up in real estate and private equity. Only 23% is in public stocks. That's supported by, interestingly, one of the best pension plans in the world, not just in Canada. Ontario Teachers has one of the best track records for investments in pensions anywhere. And since 1990, they've done extraordinarily well by putting 16% of their assets in real estate, 14%, I should say, 16% in private equity, and 8% in infrastructure. 38% in hard assets not invested in public markets. And their average rate of return since 1990, 10.2%. CalPERS, they're one of the largest pension plans in the U.S., California pension for public employees. And this is Harvard. Harvard's endowment has had a stellar track record. They currently have 200% more in assets after 40 years than they would have had they simply bought that 60-40 portfolio. And they did it by doing the following: allocating no more than 44%, and on average, in most years, around 25% to public stocks, about 15 to 25% to private and real assets, which are not just real estate, but also infrastructure, 16 to 33%. So there's very much a theme here. And that theme resonates with us. So we've been doing this independent of this information for the last 20 years, of having an allocation to real estate, where we look at the rents that we're collecting, equity, where we take a look at the dividends. We're looking at cash flow that we want to see on the portfolio. And in case of fixed income, how much interest or dividends are we being paid to lend people money? We want the cash flow from every client's portfolio to be at least 4 to 5% of their capital. So if we're looking for a long-term return of 7 or 8%, more than 50% of it we want coming from the income on the portfolio, not from hoping that we're going to get a capital gain. And that helps us manage volatility as well. So let's take a look at the results. This is going back again to January 2000. So this is the balanced portfolio, just restating the numbers, but this time after inflation, 3.9%. This number stands for volatility. Volatility reflects how much up and down movement have I had to suffer in order to get the 4% return. So on balance, 2/3 of the time, my returns will be plus or minus 6.6% of that number. So not really, this isn't actually that bad a number. But it means that in the worst quarter in 2008, this portfolio lost almost 10%. Now, if you'd been 100% in stocks, you would have done better. But quite frankly, not much better. 1% a year better over the last 16 years in the TSX. You would have had double the volatility and more than double the drawdown. Your worst 3 months would have been minus 22%. Most people aren't really happy seeing 22% of their portfolio evaporate in 3 months. And these are the results that our clients, using the asset allocation model that we have been working with for a long time, have earned since 2002. So 7.2% is the return. The volatility is less by about 1/3 than a balanced portfolio. And the worst result, which also occurred in 2008, was minus 6% in a 3-month period of time. So we are completely convinced, because of our information and others' information, that the asset allocation decision is probably the most important one you can make in doing a portfolio. All right, so let's take a look at the more recent past. So in any year, regardless of what our returns are, there are going to be winning and losing aspects of the portfolio. So another discipline we need our clients to have is to allow us to rebalance their portfolio, so winning assets get trimmed and losing assets get added to. Because from an averaging perspective and a performance perspective, unless we no longer want to own the so-called losing assets, and we'll take a look at two specifically in a minute. So last year, the calendar year, these 3 categories, Canadian equities, high-yield bonds, and preferred shares, lost money. And they, on average, lost 7.5%. Meanwhile, the other categories collectively rose in value 11.4%, and they represented 75% of a typical client's portfolio. So the weighted return last year was 7.4%. What we want to do is rebalance. We take money from the green, we add it to the red. It's not complicated, but it is very important to do that. So I remember I said this was the balanced portfolio differential for the last 16 years. And in the last 15 months, when the markets have been even worse, this has been the differential. So what you'll find typically with an asset mix like I've just described is in a bull market when things are great, let's think of 2009, 2010 during the recovery, the asset mix that we're describing will match that of the marketplace. It'll keep pace with the marketplace. Where it performs the best is when markets are depressed. So basically in 2011 and in 2015 is where you start to see a very big difference in performance.